All right, we are moments away from the start of trading here this morning on this Thursday, the day after Christmas. They call it Boxing Day over there in the UK. I'm Paul Sweeney, along with David Gurr. We're here in New York City. This is a special edition of Bloomberg Markets on Bloomberg Television and Radio. Interesting to see how we kind of close out the year. Again, you're going to get 24, 25% return in the S&P 500. That's darn solid. I mean, I can't imagine anybody complaining here.
Struck by those we've talked to this morning have said, maybe not expect gains of that size going forward, but still very optimistic about equities in particular in the year ahead.
Yeah, and then if you look at the S&P equal weighted, only about 14 or 15% return year to date. So, if you weren't in some of those, only. Yeah, exactly. I should be only. But if you weren't in some of those, big cap tech names, maybe you missed out a little bit. So let's take a look at some of the stocks that are moving under the surface. Bloomberg's Alex Semenova. Let's start with Apple. Alex, what are you looking at there?
Yeah, so it got a price target upgrade this morning, unsurprisingly from Wedbush, being raised to a street high of $325 from $300. Dan Ives, who is obviously somewhat of a permabull on Apple, writes that the company is heading into a multi-year AI-driven iPhone upgrade cycle. This upgrade cycle, he says, is still being underestimated by Wall Street. The firm sees a growth catalyst from a new multi-billion annual services revenue stream. This is due to its apps built around AI technology, and it expects upgrades across the board for the next 12 to 18 months. It has an outperform rating, of course, on the stock. A very small move higher this morning, up about 0.4%. It is up more than 30% this year, of course, outperforming the S&P 500.
Let's go from Apple to Progressive.
Yeah.
Another stock I know you're watching this morning.
Yeah, also a name that is getting an upgrade on the street to outperform from market perform at Raymond James. The firm says that its long-term record of growth and value creation makes it a core holding for large cap growth investors. I was looking at the move year to date, up 53% year to date, guys. Pretty incredible move for Progressive.
How about on the crypto space here? I'm looking at Bitcoin, calling that out for Tom King, because I know he wants his quotes as he's sitting there at the cafe in Paris. 95,000 on the crypto, down about 3% here today.
Yeah, of course, we've been watching those stocks closely. Down this morning as Bitcoin retreats. Names like MicroStrategy and Riot Platforms, these names that are closely tied, of course, to the moves in cryptocurrencies. And the declines come even as MicroStrategy is seeking to increase authorized shares to purchase more Bitcoin. It, of course, already bought $561 million worth of the digital token. The stock has seen a bit of a retreat recently because it did buy Bitcoin at an all-time high before it pulled back a little bit. So those names under pressure this morning.
Interesting just to look at the role that MicroStrategy continues to play as kind of this catalytic force in the world of Bitcoin. Alex Semenova, thank you very much for that update. She'll be here throughout the morning. Joining us now is David Sowerby, and Core Portfolio Manager, here with us on this Boxing Day. I guess not in the U.S., but around the world.
I'm celebrating.
You're celebrating, I know. But we're supposed to celebrate with the day off.
Canada, too.
Canada as well.
Yes.
Well said. The Commonwealth Law.
My neighbor to the south.
Yes.
Right.
David, great to speak with you. I want to start just by, before we look ahead, looking back on this last year, what lessons will you carry over from the way the market performed this year? And if you kind of think of this as chapters, how much is the story the same here going into 2025 for you?
Enough of the same, but one very good same is never underestimate the ability of solid U.S. companies to deliver superior capital allocation, shareholder value creation in the face of higher interest rates, questionable fiscal policy. Time and time again, bet on U.S. companies. That's been the rule of thumb for 30 plus years.
David, I mean, am I going to be lazy in 2025 and just hang on to my Mag 7, or should I take a little bit of roll up my sleeves a little bit, maybe take a look at some small caps, some mid caps, maybe some sectors or factors that haven't really performed over the past 2 years?
Well, Paul, I don't root against the Mag 7, but I think you have to think broader, more participation in the markets. We saw this rotation since July 11th, where small caps outperformed quite well, value outperformed growth, the Mag 7 lagged, and here we go into December. Mag 7 right back on the treadmill. Small caps have still modestly beat large caps since July 11th, 10% for small caps up, 7% for the S&P 500. It's that two steps forward, one step back in December, but I think we're back to small caps having very good returns in 2025. relative to some of the mega caps.
David, count me among those who hears that watchword or those watchwords, small caps, and just sort of wonders what to do with it. Where are you looking when we talk about small caps? Where is there opportunities you see it? What's your counsel to your clients about what sectors, what types of companies are of interest in that world?
A proven process for 20 plus years. 2 buckets to look into. First, spin-offs. Small company spins out of a larger company, unlocks shareholder value. Look at the Bloomberg spin-off index in 2024. It's up better than 60%. That's the first bucket. The second bucket is underfollowed companies where there's only 2 or fewer Wall Street analysts following the company compared to the previous story on Apple. So an example is National CineMedia, ticker symbol NCMI. Only 2 analysts follow the company. They do that advertising when you go to the movies.
Hate it.
And you get there early and you see that captive audience for advertising at National CineMedia, over 1,000 theaters they're in. There's an idea for an underfollowed small cap stock.
And that stock's just ripped. It's up 60% year to date with a market cap of about just $625 million. So that thing has worked here. David, how do you think about valuation here? Because I've got a Fed that I think maybe they're going to cut a couple of times in 2025, but I think that's it. It feels like earnings have to be a real driver of this market going forward. How do you feel about earnings vis-a-vis valuation these days?
All valuation rich. No other way to describe it. If you go on a free cash flow basis and value the market that way, not as rich, still opportunities for the investor. But you nailed it. It's a tug of war in 2025. Earnings, free cash flow, dividends will all be up 10% or better. That's pulling on the upside, but valuation is stretched. And I looked back to 1990. There have been 9 years in a calendar year where valuation went lower. And in those 9 years, the market only finished positive 4 out of 9 years when valuation slipped a bit. So that's the tug of war for 2025. Rich valuations, I hope they don't go lower, with earnings and free cash flow up double digits.
I could detect in what my friend Paul Sweeney was saying some disdain or eagerness to stop talking about the Federal Reserve as much as we have been over the course of this last year. What's the role that it's going to play in 2025 as you see it? I know you were listening closely to that press conference just a couple of days ago. How much is it going to be continuing to drive things going forward here as you look at valuations, as Paul suggests, other facets of investing beyond what the oracles down in the Eccles building are telling the market?
Well, you're in New York, so let's borrow from a famous New York investor, Reggie Jackson. The Fed is the straw that stirs the drink. So if the market only gets 2 interest rate cuts next year, I don't think the Fed should do any more. Their number one mission should always be price stability. And if the market doesn't like it in the near term, you have to grind through it. But at the same time, if inflation is not brought even a bit lower, just look at what the market did from 1965 to 1981. It was flat on an inflation-adjusted basis. It dropped 40 to 50%. So we have to be encouraging that the Fed stays committed to inflation. And that's going to be a story in 2025 in that tug of war relative to the, I think, favorable earnings, free cash flow, and free cash flow margins that'll still exist.
David, I've been doing this Wall Street thing since 1986. One of the really interesting markets to watch develop has been private credit. Talk to us about Ares Management Corporation.
Ares is one of the largest private credit publicly traded companies, so bank loans in particular. And that has been an insatiable appetite for pension funds. I sit on the City of Detroit's investment committee, my alma mater, Wayne State. I chaired the State of Michigan Pension Fund for a number of years. The demand for private credit continues to grow because the expectations are you can get near like public equity returns without the same volatility. And that plays into a name like Ares, which is one of the largest private credit publicly traded companies.
You know, let's take advantage of the fact that you're there in Michigan. I'd love to get your sense of sort of not the politics of the election per se, but what issues were front and center, particularly in your home state, and what that tells you about what to focus on here in the years to come.
The economy, first and foremost, that cumulative inflation was up better than 20% since early 2020, 21. And I think that's why Michigan, perennial swing state, swung back for incoming President Trump relative to 2020, 2016. We end up voting with our pocketbook. The other factors matter, but I think that was the key reason for Michigan going back to Trump the way they did in 2016.
David, when you and your team woke up the day after Election Day, did you change your investment outlook for 2025 at all?
Generally, no, because I can't predict politics, Paul. My axiom in predicting politics is never expect Washington to do the right thing. They do the least amount to fix a problem. That said, after the election, you saw small cap stocks the day after pop 3 to 4%. That was validation that animal spirits were going to be resurrected, and we saw that November NFIB optimism index take a decided spike higher. That can be a factor that bodes well for the market next year, and in particular, animal spirits and small cap cyclically sensitive stocks.
You can't predict politics. Let me just ask you about geopolitics in terms of what you're watching and how that maybe colors your appetite for, say, assets outside the United States, equities overseas, other opportunities. Are you staying pretty closely focused on the U.S., or do you see opportunity across the Atlantic?
Outside the U.S., it's interesting, but the bias is still in U.S. domestic portfolios. And since the end of 1987, U.S. stocks have compounded five percentage points better compound annualized return, superior than the MSCI EFA. That goes back to the superiority of U.S. companies delivering shareholder value. The bar is high to have meaningful assets out of the U.S. You get enough diversification here, given our indexes.
So, David, what's your message to your clients? Do you have a thematic message to your clients for 2025?
I'm generally not that creative. Other than, keep your head down, find good companies that are generating capital and free cash flow to the investor. And at the end of the day, I'll have the same 5 risks that every Wall Street analyst has on the street. But ultimately, it's always going to be the risk you don't know that bites you the hardest.
Mm-hmm. David, do you still have clients who are on the more conservative side of things, who are part of that $6 trillion cash pile, who are reluctant to get back into this market? And if you do, what's the counsel you're giving them to jump in?
Generally, no. But if there are some, you just want to take a look at the potential for the S&P 500 or the average stock in the S&P 500 to compound 7 to 8% over the next 3 years. You're not going to get that in Treasury bills or Treasury notes. And the probability is probably better than 80% that the U.S. and the S&P 500, the average stock, will compound better than cash. I like those odds. The next calendar year, flip a coin. But the next 2 or 3 years, you feel like equities will still meaningfully outperform cash.
All right, David, thank you so much. We always appreciate getting a few minutes of your time. David Sowerby, and core portfolio manager from the great Midwest, out there giving us some views. And that's kind of what we need to get off this rock every once in a while, dude.
As we can. Although it's very cold there.
Yes, we can. Exactly. Exactly. So we'll have to see how that plays out. But the market's just a little bit of a sell-off here on this December 26th, the day after Christmas, Boxing Day, for our good friends in the greater UK. Coming up, we're going to get a little bit smart here as we talk to James Seifert. He's at Bloomberg Intelligence. He does the ETFs. That's another crazy growth story.
Eric Balchunas' right-hand man.
Exactly. I mean, they're interchangeable, and they've got everything you need to know about the ETF space, but they're in a business that just goes up and to the right.
Yes,
I could sound smart on ETFs if you needed me to. But James Seifert from Bloomberg Intelligence, he's the ETF analyst. He's going to join us coming up in the next block. This is Bloomberg. All right, I'm Paul Sweeney alongside David Gurr. We're in New York City in our Bloomberg Interactive Brokers radio studio. We're simulcasting on radio and TV. That's what makes it a special Bloomberg Markets here.
Platform.
What's that? Yeah, it's great.
Multi-platform.
We
What do
got
you
everything
say?
going on here.
Yeah.
And I'm sure they're going to cut it up for some kind of podcasting intraweb type of thing.
And maybe
going
some
forward.
awards.
Yes.
As well, if we're lucky.
Exactly right. Looking at the markets here in this first 15 minutes of trading, S&P trading off about 15 points, the NASDAQ off about 50 points, so about 0.25%. Not much happening as you would expect. Lighter than normal volume. Yields grinding higher. That's how I'm going to continue to characterize them. 10-year Treasury up 4 basis points, 4.63%. I'm not refinancing my mortgage anytime soon. The rates market is not cooperating. WTI crude oil pretty steady here, just around $70 a barrel. Tom Keene, the Bitcoin quote of the morning, down 2.9% at around 95,500 for Bitcoin. So there you go, David.
Holiday shout out to one Tom Keene. Well, markets appear to be ending the year on a high note, but there is a perspective on Wall Street that U.S. equities are due for a downturn. Interactive Brokers Group Chairman Thomas Peterffy holds that concern. He recently spoke with Bloomberg's Sonali Basak about that and his thoughts on cryptocurrency.
I'm afraid that the markets are becoming overextended and that, sometime in the future we will have a downturn in the markets. But I don't think it's going to be a very violent and very far. It will not go very far. So I'm extremely optimistic about the next 4 years and maybe even thereafter.
The other thing where a lot of investors are expecting much lighter regulation is in the world of cryptocurrencies. How do you feel about cryptocurrencies from where you stand? And do you think that when your clients are going to Interactive Brokers, it's going to be something they're asking about more and more and more?
So cryptocurrencies are a very interesting area. We have been into cryptocurrencies for about 3 years. We charge less commission on a cryptocurrency trade than any other firm other than Robinhood, but Robinhood has a wider spread because they get their commissions paid by the market maker who they send their orders to. So I think on balance, our platform is probably the most efficient one for a crypto trader. Otherwise, to tell you frankly, I'm a sort of scared of cryptos because, they can go to any price because it's basically just a figment of imagination. So it doesn't have any underlying value. The only value it has is the same as the paper dollar, which is nothing.
But you've seen people pour in nonetheless through ETFs. You saw the price of Bitcoin get to $100,000. Will the investor of tomorrow be more likely to buy Bitcoin or a U.S. stock?
Well, it depends. Well, for a Bitcoin, you can buy U.S. stocks, right? For a U.S. stock, it's more difficult to buy Bitcoin, right? So I think that anybody who does not have Bitcoin should have some Bitcoin, but not too much. I would recommend that people put maybe their 2 to 3% of their net worth into Bitcoin. And we, for example, will not allow anyone to invest more than 10% of their assets into Bitcoin because I think that would be very dangerous.
All right, that was Interactive Brokers Group Chairman Thomas Peterffy speaking with Sonali Basak, talking about the markets and the outlooks here. Well, it has been a big year for ETFs. We've been saying that for a number of years, and many other ETFs, just in general for that matter. The industry saw $1 trillion in inflows in 2024. That's a record, folks. There were 670 fund launches this year. For more on what to expect for 2025 for ETFs, we are joined by James Seifert. He is an ETF analyst for Bloomberg Intelligence. James, you and Balchunas, I mean, you guys were born on third base. You thought you hit triples here. You are just on top of this ETF business like nobody else we know. We appreciate getting a few minutes of your time. What are you guys thinking about for 2025 for the ETF business?
Well, thanks for the kind compliments, and thanks for having me. It's kind of a backhanded compliment in a way, but yeah, I mean, this industry is on fire. I mean, this is where the money is going in traditional finance. If you look at however you slice it, I mean, I guess you could look to private credit and some private vehicles. There's a lot of money going in there. It's a little more opaque, obviously, the private name. But as far as ETFs go, as you mentioned we had over $1 trillion in inflows this year. That's just in the U.S. We're seeing massive inflows around the world. It's not just a U.S. story, it's a global story. So there's a lot of different things we're launching. We're seeing things getting more conservative, people launching products that people want to protect their downside. And we're seeing a huge growth in products of people that want to, lever themselves up and go 2x in single stocks. So we think all of that is going to continue. And we think we're also going to see an increasing trend of money going from the mutual fund wrapper into the ETF wrapper for a whole host of reasons.
James, there's been a lot of, shall we call it, thematic creativity in the ETF space over this last year. I've talked to Eric a bit about that. Are we seeing any winnowing, Paul, going through the stats of how many of these funds were launched over the course of the last year? What's the general sort of longevity of the funds that have been created so far, and sort of what accounts for the degree to which they're getting winnowed down, if at all?
Yeah, so I mean, it's kind of the same thing that happens in many areas of the ETF industry. It's pretty common in traditional finance, really more broadly. Things get really hot, people get a lot of interest, a lot of money pours in, and they overbuild or over-launch products. And then over time, the products that didn't gain enough asset, aren't profitable, you name it, they'll start winnowing those things down. We're seeing a little bit of that now. Flows have slowed to the thematic sector, but still, we're pretty bullish on themes as far as a category of the ETF wrapper. Kind of what it does is it's like, we call it conversational alpha for these advisors. They can talk about they're selling robotics, they're getting you involved in infrastructure. And a lot of these types of themes, it's more so, you're not investing in these products and you're investing in a sector ETF. These theme ETFs are going across a whole bunch of different sectors. So if you're looking at infrastructure, it's energy, it's industrials, materials, you name it. And you're basically getting these stocks across a whole bunch of different ways. So it's kind of repackaging sector investing into, a more conversational way of talking about investing. Obviously, there's been some ETFs that have been hit extremely hard. They tend to be volatile and risky. They're not always extremely diversified, but people like to invest in these things. What we see them being used as is, instead of thinking of them as like people are selling their S&P 500 ETF, it's more like they're investing in, a robotics ETF or a cryptocurrency equity ETF instead of going, a single stock. So it's more a single stock substitution than necessarily a broad allocation substitution that we're seeing these things used for.
Hey, James, I grew up on Wall Street as a sell-side analyst, and my customers, my clients were institutional, mutual funds. What is the future of the mutual fund today? I mean, I just don't know where they go long term, because it seems like all the fund flows are going to ETFs.
Yeah, I mean, no matter how you slice it, money is coming out of mutual funds. A lot of it, I would say most of it, is finding its way back into the ETF wrapper. Some is finding some more private vehicles, SMAs, CITs, these other things that aren't a little more opaque, those private funds I was talking about before, but a lot of it is coming into ETFs. And if you just look at a trend of flows out of over the last 10 years, the money's going out of mutual funds and ETF. A lot of it has to do with it's money leaving high-cost products and going to low-cost products. One of the things we're seeing and we think is going to happen, there's over 30, I think there's 36 issuers that have now filed basically to bolt on an ETF share class to their mutual funds. So people are probably familiar with mutual fund share classes. Basically what a lot of these issuers want to do is bolt on an ETF share class onto the end. Vanguard's structure has been like this. They've kind of been grandfathered into this process. A lot of other issuers are going to follow suit as soon as the SEC allows this to happen. We think 2025 could be the year that these things finally get the green light from the SEC. The one thing I would say is that if these are approved, it often takes like a year, 2 years, maybe a little bit more before we see a huge trend of people jumping on the bandwagon and figuring out exactly how they want to do this. But there's a pileup of issuers and asset managers that want to do this. And we'll also see the opposite. We'll see some really successful ETFs. There might be reasons like 401k wrappers and things where they might even bolt on mutual fund share classes to the ETF. So there's going to be this whole trend. I think the trend is clear. It's going to be mutual funds to ETFs, high cost to low cost. It's a little bit right now, it has been active to passive, but that's starting to change now in the ETF world. Active is doing extremely well.
James Seifert is an ETF analyst at Bloomberg Intelligence. James, great to speak with you about all that's happening in this space. And James, bringing up just a moment ago the prospect for more approval by regulators. Of course, there's a lot of optimism that under Paul Atkinson's presumed leadership of the SEC, maybe some more of these crypto-based ETFs are going to get through. I think there are a lot of crypto investors, institutional investors, who are watching that space, looking to see what happens in that way. And as he was talking about, just the amount of growth that we've seen in ETFs overall has just been astonishing. And your question, Paul, a very good one, just about what happens to mutual funds as we see this kind of pivot away from them into ETFs. And just certainly a lot happened here in 2024 in that world, a lot likely to happen here going forward. Coming up here on Bloomberg, Carol Pepper is going to join us at Pepper International. She's the CEO as we look at her outlook for 2025. This is Bloomberg.
Good Thursday morning. Good Boxing Day morning. I'm all in on this Boxing Day thing. I'm Paul Sweeney alongside David Gura. This is a special edition of Bloomberg Markets. Why is it special, you ask? Bloomberg TV and radio simulcast.
The conjunction is the special
the conjunction is, exactly. We're all in on the conjunction here. Looking at the markets here, just a little bit of a sell-off, folks. Look at the S&P off about 15 points, the Dow off 90 points, the NASDAQ off 66 points. All that kind of, it's like 0.2%, 0.3% sell-off. We're about 25, 30% below normal volume here, as you would expect on holiday week here. Yields pushing higher here. 10-year Treasury 4.62%. WTI crude oil pretty steady, heading just sitting right around $70 a barrel. And Bitcoin down 3% here, 95,400 on the crypto currency. So there's not a whole lot going on out there, but we're going to stay on top of it for you.
Our volume is steady.
We're here.
Output is
We're here every day.
strong.
We're here. We just crank it out. We're here every day. The markets are open, which means we're open. It's very simple for us. Let's take a look at some of the stocks moving under the surface. Bloomberg's Alex Semenova joins us here in our interactive broker studio. Alex, what are you looking at?
Guys, so of course a bit of a down day in the market today, but Apple's still up about 0.3%. This is after it got a price target upgrade from, unsurprisingly, Wedbush. Dan Ives raised it to a street high of $325 from $300. He said that the company is heading into a multi-year AI-driven iPhone upgrade cycle. Basically, he's saying that with all the app upgrades from artificial intelligence, consumers are going to upgrade their iPhones. I don't know about you guys. I'm probably due for a new iPhone as well. He has an outperform rating on the stock, of course. Big Apple bull, Dan Ives. The stock, very small move today, but up 34% year to date. Incredible rally in that company.
Dan is a pro. First of all, he's a perma bull on everything. But on Apple, he knows what he's doing here. Nobody's in the office today. There is no news. So when you just raise your price target, it gets a Bloomberg head. It gets Alex Semenova talking about it.
There
It
we
gets
go.
him in the news. He knows what he's doing here in terms of that. So I admire him for that.
Nobody's escaping the real talk from Paul Sweeney today.
No, exactly. And by the way, he is a perma bull not only on tech stocks, but also on Penn State football. I bet you that he will be at the Fiesta Bowl rooting on his Penn State Nittany Lions.
We will check in with him shortly after
Very
this. Alex, I know you're looking at retail, not here in the U.S., but in Asia. Alibaba, very much in the news this morning.
Yeah, another company on the move. This is after it agreed to merge its South Korean operations with Emart's e-commerce platform. The move is intended to help the company better compete in the country's fast-paced online retail sector. This is a 50-50 joint venture. This is according to a stock exchange filing by Emart, which confirmed a Bloomberg News report. Our reporters here, of course, getting the scoop on this deal. People familiar with the matter say that it is estimated to be valued at about $4 billion. Little move here on Alibaba, about 1%, but it is up around 11% this year, valuing the firm at about $200 billion.
My good friend Joe Tsai from high school, co-founder of Alibaba, he nicely retired. He was all happy, owning the nets, having some fun. Jack Ma says, no, you need to come back and work and kind of run this company. And
advantageous for him.
Exactly. So my boy Joe's back at work.
How about just in terms of any sectors you're watching, kind of winners and losers over the course of the trading day thus far?
Yeah, it's of course been an incredible year, actually. Just taking a look at the S&P 500 leaderboard, all 10 of 11 S&P 500 sectors in the green. Some of the winners include communication services, information technology, consumer discretionary stocks. These are, of course, some of the sectors that house these so-called Magnificent Seven companies. NVIDIA, Tesla, all in those names. Financials is also a winning sector, with investors expecting deregulation, increased merger activity, utilities also benefiting from the AI frenzy, one of the sectors that really got a boost from expectation for more data center usage. And then some of the losers, even the losers are in the green. You have real estate, healthcare, energy, underperforming the S&P 500, but still up year to date. Real estate, of course, weighed down by higher interest rates. Healthcare, because investors are opting for growth-focused sectors like AI instead of some of the cyclical sectors like healthcare. Energy as well, due to volatility in oil prices. Falling oil prices expected to kind of hurt some of the oil companies' earnings results. And then materials is actually the only sector that is slightly in the red, but even flat year to date.
Alex, thank you very much. Alex Semenova joining us here in the studio. We'll have more updates on the markets over the course of the morning. I'm going to pick up on what we were just talking about there as we bring in Carol Pepper, the CEO of Pepper International. We're going to talk a bit about her outlook for the year ahead. Alex bringing up the Magnificent Seven. There are plenty of Grinches who are saying it's overdone, it's been too narrow, maybe we should be a little more pessimistic as we get ahead into 2025. Carol, what are you thinking? How much optimism are you allowing to seep into your outlook for the year ahead?
Oh, I'm very optimistic. I think this is going to be a fantastic year in the markets. First of all, we're still in an election relief rally as far as I'm concerned, because people are very happy. The U.S. transitioned successfully, and we're looking toward a very good 2025. There are so many family offices, for example. I manage money for family offices with over 100 million, and believe me, all the 500 millionaires want to be billionaires this year. The way to do that is to get invested into the market. This is no time to wring your hands on the sidelines and think what might happen. Look at people who did that last year, missed a tremendous year in the market. So I'm very optimistic. I do think the leaders will continue to lead. I think we're only at the edge of what AI is going to be able to do. So good year coming. Put the fear away and let's go make some money.
That's to be a 500 millionaire.
Yes.
I'd take it. Sure. Exactly, I wouldn't wring my hands,
Hey, Carol, I want to follow up on that. Carol, can you tell us, what's a typical client of yours, and what's a typical family office these days? Is it somebody who owned a business and they sold their business and now they really have to think about, boy, what do I do with all the proceeds? What's a typical family office account for you?
Yeah, I mean, there's a lot of folks out there who have made an exit and they're ready to now start going on to the next stage of diversifying and moving away from their operating company. There are a lot of real estate billionaires and millionaires, multimillionaires out there who are transitioning the business to the next generation. So they're ready to build a more robust structure for, again, diversifying outside of their core real estate holdings. And there's just a lot of people who are, kids are getting ready to take over the business. Quote unquote, kids are 30 and 40. Mm-hmm. And now it's time for them to take over all the family holdings, and they want a family office because it's a much better way to actually organize all your affairs effectively. And from a tax advantage point of view, from an estate planning point of view, you want to be one of those families that makes it past the second, third, and fourth generation. You need a family office. And I've been in this business for 24 years, and I've seen the tremendous growth in family offices because it is the right solution. Each one can be tailored for each family's requirements.
Carol, you mentioned tax policy, and it's a good jumping off point for me to ask about the year ahead when it comes to policy, and President-elect, of course, talking a good game about Congress's ability to renew the tax cuts he put in place when he was in office last time. What are you telling clients just about how they should be gaming that out, what the tax picture is going to look like in the year ahead? How much of a sure thing or a done deal do you think that renewal is going to be?
I think it's a fairly good done deal, actually. I do think that those deductions were very popular. I think they will consider. I think that's one of the reasons a lot of people voted for Trump. They really were looking for a lower tax policy, and that was a big driver in certainly many family offices' decision makings. What can we do about tax policy? Because family offices really believe a lot in, returning money to the people that made it and letting them see how they can invest it on behalf of society and themselves. So yeah, I think that we're probably going to get the tax breaks that we want this year. At least the first year. Once we come to the midterms, of course, all bets are off. We'll see.
Exactly. All right. So for 2025, is there a theme you're stressing with your clients this year, Carol?
Sure. The big become better.
Wow. I like that.
With NVIDIA. Stick with Amazon, stick with Apple, stick with the winners. The winners are going to win more. It's a winners take all type of a market, and you can't fight that. You don't have to be cute. You just have to follow the massive trends, and then you'll win. I mean, it's really not a hard market in that respect. But what will be hard is when there are those pauses and consolidations, you have to stick to your convictions and stay invested. This is not a market to trade in and out of. Just ride it up to the end of the next year. And when we're having this conversation, we'll be very happy we did that.
Is there anything novel about the market that we're in right now as you see it? I've heard some folks talk about the fact that traditionally when you have a bull market, it starts kind of broad and narrows. And here, I guess, if you look at the bull market we've been in, we've seen it start extremely narrow, talking about the Magnificent Seven once again. Broaden out a little bit. It does strike me that's kind of unique when you look at history as kind of a guide for what this market's doing.
Yeah, well, because that implies that, there were fewer and fewer winners as time went on in those polls, and that's how they petered out. But in this case, actually, a few companies started the AI craze, and that is now going to spread to larger sectors. We're seeing this now, for example, with the spread of AI fever into the utilities sector. Who would have thought of sleepy old utilities as an exciting sector? But you're going to have great dividends, and you're suddenly getting a lot of new technology applied to that sector. So this new technology, we don't even even know yet what it's going to be. It's just in its infancy, and it's going to spread. So we'll go from more narrow to wider this time. I think that's a great observation. And that calls, in my mind, that means we're going to have a very strong year this year. There'll also be a lot of enthusiasm to give President Trump a chance. So let's see what he can do. But it's not just him. It's going to be the Congress. It's going to be the Senate. And then, again, you have to look at the rest of the world. There's still a massive inflow of non-U.S. money. I work with a lot of non-U.S. family offices, and they love this market. In comparison, our market is phenomenal, and there's a massive weight of money that will continue to flow our way.
All right, that's
the point you've been making all morning.
Yeah.
That point about international money is what you've been hitting on.
It's just been amazing. We hear that more and more. Carol, what could trip us up here? I mean, I know you have a bullish call
Trying
there.
to get some pessimism out of it.
Yeah, let's throw some pessimism out there. What could really, I mean, other than a black swan that none of us can predict, is there any risk out there that maybe either you think about or your clients think about?
Yeah, well, I mean, if you're in New York, you can't help but thinking about the real estate risk. You know, everybody's been rolling the real estate risk over and over again, and you know the rates are just not low enough right now to really get people moving on real estate. Real estate is a massive sector in our economy, so I hope we get more than 2. It'd be nice if we got 3 cuts. I think that would help. So keep your eye on real estate and be careful about real estate. But I do think when it turns, there's a lot of pent-up demand. It's just a question of will it break before it turns? That's the real question. It's hard to tell right now.
We got these jobless claims data this morning, kind of meh, although as our colleagues pointed out, the highest we've seen in a couple years, I think.
Yeah.
When you look at the health of the overall economy, again, picking up on the fact that you're very optimistic about the path forward here, are there any, if not flashing red lights, things that do give you pause or things that you're returning to, more data points you're mostly interested in checking in on?
Yeah, well, I think you do have to watch the labor market, obviously. But again, it's fairly flat. It was overall claims were down 1,000. It was, of course, ongoing claims that were up a bit.
Yep.
And would that data point have gotten so much attention if we weren't in Christmas week? I'm not so sure. So it's pretty much been a steady picture. But yes, you have to keep your eye on the overall economy. But you have to keep your eye right now on consumer confidence and how are people doing. They were out shopping. They're still going to keep going forward. They're going to keep borrowing. It's the American way. So I'm not that worried about our economy. I think we really did achieve a soft landing, and this gives us a tremendous runway to start moving toward growth now that we have inflation relatively tamed. I mean, yes, is it not too, if it were only 2% or 1%, probably the economy would be in a lot worse trouble than it is. So inflation doesn't worry me. I think we're in a steady path, and with a little bit of tax help, we could actually have a really fantastic year. So I'm not terribly worried about this economy, and I do see that weight of foreign money continuing to prop up the market because on a relative basis, we're still the best game in town. And all those family offices want to make more money this year. So a lot more money that's on the sidelines is going to come off this year. They were waiting last year, nervous about the elections. I think more nervous maybe than they needed to be, but they were just worried. And so now that we've gotten past that, I think, the green lights are going to be on, and people that have been waiting around and missed 30-year upswing in the NASDAQ, for example, last year, they missed 30%. That's a lot to miss. We'll probably dip their toes in, at least get started this year.
Some optimism there from Carol Pepper of Pepper Internet. Plenty of optimism, and I'm grateful for it here on the eve of New Year's Eve. Some of the busiest travel days ever just happened this past week. Talked about retail. Let's talk a little bit about that. We're going to discuss that coming up here on Bloomberg.
All right, Paul Sweeney alongside David Gurr here in New York City. It is a special edition of Bloomberg Markets. We are simulcasting on Bloomberg Radio and television. A little bit of sell-off here in the market. Not going to oversell it. S&P off about 19 points. That's 0.3%. The Nasdaq off about 95 points. That's about 0.5% there. 10-year Treasury yields, they're grinding a little bit higher, up about 4 basis points. Let's call it 4.63% on the commodities front. WTI crude oil absolutely steady, right at $70 a barrel. That is a trading range, folks, for crude oil. Gold higher. How about that for this year as a great performing asset for you? Thank you, David Gardman of the Gardman Fund. Bitcoin, we're off 3%. That's 95,400. Remember, we were 107,000 on Bitcoin just a couple of weeks ago, so lots of volatility there, David.
Yeah, we're looking ahead to 2025, focusing on different sectors. Let's talk about travel a little bit now. And Carnival's initial outlook for 2025 bolstered confidence that record levels of cruise demand will continue into the next year. CEO Josh Weinstein spoke with Bloomberg's Carol Massar and Tim Stenovec.
If you think about what was our booking activity, how much activity did we generate in the last quarter? So from the period of September through the end of November, that beat last year, even though we had less to sell. So we sold more for 2025, and we sold it at higher prices versus same time last year. And at the same time, we set a record for booking activity for the following year out. So in this case, 2026. So things are moving really positively across the board. And the great thing is, this is broad-based. So when we look back at 2024 and we look at our portfolio of world-class brands, we were actually higher, mid-single-digit to mid-teens percentage-wise in our yields in the revenue we generate per person per day across all of our major brands, all of our major trades. So it's really gratifying. The team, our global team, has done a phenomenal job, and really a shout out to each and every one of them for doing what they do.
Okay, this maybe sounds a little bit stupid, but why do you think this is happening? I mean, and I'm just curious, what it is it? Tell us a little bit about it. Remind us, because you do have a portfolio of brands, and it reaches across different consumers, if you will, of your brand. So give us an idea of why you think you are still seeing kind of record bookings.
We'll need an hour, right? I mean, there's so many reasons. The principle, and I remember being on with you a year ago and talking about what we'll call the price to experience ratio, and the price to experience ratio of a cruise versus the price and what you pay for a land-based alternative is nuts, right? I mean, the value that you get from a cruise for what we provide is night and day to what you can get on land, and people are recognizing that. And so we are casting a net much wider into the general population for people who will now consider cruising as a vacation alternative, people who have never cruised before. As a matter of fact, in 2024, we had over 10% more new to cruise than we did the prior year. So becoming more mainstream, breaking down myths, and that value gap is real. So we can still increase our pricing, as we've been doing the last few years, and be an incredible value.
All right, that was Carnival CEO Josh Weinstein speaking with Bloomberg's Carol Massar and Tim Stenovec about the cruise business. I am not a cruiser, David.
You're not?
No, are you?
I'm not. I've never been on one.
Charlie Pellet is the cruise dude, and he goes everywhere. But I'm fascinated about the economics of the cruise business. I think the economics are really good when you think about kind of what drives it. I've owned the stocks in the past. I've owned the bonds in the past.
But never set foot on a vessel.
No, but that may change going forward because I'm stepping up my travel game here. That's the stage of my life I'm at. But the economics are just phenomenal to me for some of these really well-run cruises. But I remember the earliest days of the pandemic, literally day 1, day 2, day 3, these cruise companies were out there issuing debt because they knew that they were going to have
before they could get the passengers off the boats.
Yep, they were out there in the debt markets firming up their balance sheets. Let's talk about travel, because what I understand, people are traveling this time of year. James Ferrara joins us, IntelliTravel CEO. James, I'm not one of them, dude. I'm staying close to home. I'm not going anywhere. These people are nuts that are out there, but they're out there on the roadways. They're in the airports. What are we seeing in terms of holiday travel this year, James?
Well, it feels like you're the only one staying home. Happy Boxing Day, and welcome to the busiest holiday travel season on record ever. So people are visiting family and friends, obviously, and they're also getting away. And we've had the busiest days. December 1st probably will wind up being the largest, busiest day of the year, most traffic. The 20th to the 22nd also. But the biggest, second biggest one of the year is tomorrow, actually, the 27th. And then we'll have another huge one on the 30th. So if you are traveling and for some reason you haven't made your flight arrangements, or you can move to New Year's Day, because Christmas Eve and New Year's Day are actually very light days at the airport.
You know, Paul, invoking the pandemic, and I wonder, when you look at the numbers that you're seeing over the course of this last, let's call it a month, how does it compare to what we saw before the pandemic? Are we back? Are airlines back to where they were before? And what are they saying about their ability to deal with and process and have that many passengers going through airports day in and day out?
Yeah, well, we surpassed 2019 last year, and now this year we're about 6% ahead of last year, so setting another record. 2019 is in everyone's rearview mirror, but the system, we get some reminders. I mean, you, of course, heard about the American Airlines computer glitch on Christmas Eve. We had a couple of snowstorms in the Northeast, heavy rainstorms in the Pacific Northwest, and the threat of even a government shutdown, a federal government shutdown. The system is fragile, and any of these types of things can disrupt it. We actually, to use a terrible phrase, dodged several bullets this year and wound up okay so far. And I don't see anything that indicates that we're going to have the same kind of problems that we had, let's say, in 2022. Many people remember the Southwest Airlines meltdown that year.
James, where are people going? Because it seems just anecdotally over the last couple of years, young kids, including two of my offspring, Barcelona, like, where did that come from? It's like Barcelona's the new Paris. I have no idea what's going on there. I missed that boat. Where are people going? Where do you think they're going to go in 2025?
So domestically, there aren't a lot of surprises. New York, Las Vegas, Orlando, of course. Big one now is New Orleans. Yeah. Especially have young people. They love it there. Honolulu is also on that list. Internationally, people are going to Punta Cana in the Dominican Republic, Cancun in Mexico. Dubai is a really hot spot now. And the Bahamas, London for European capitals. Those are typically, that's what we have at the top of the list. There aren't a lot of surprises there. The trend for this year, though, the thing that's new is the more overlooked places. We're really pushing more into that off the beaten path kind of mentality. And this is driven a lot by young people and by a sort of global wanderlust that everyone has. And it's also driven by a concern for over-tourism. So you bring up Barcelona. Barcelona is an amazing city, but it is too crowded, and it has begun to push back, right? We saw over the last year protests and so on. So people are going to Sardinia, for example, for a taste of Italy, but it's not Rome, it's not Venice, it's not those incredible tourist crowds. Colombia in South America, very popular for this year. New Zealand, not Australia, right, for fewer crowds. Vietnam, Slovenia, for a taste of Europe, off the beaten path. Most people haven't been there, and much less crowded.
I see Paul taking notes here, writing Slovenia down on a piece of paper. Great to speak with you. Really appreciate the time. That's James Farrar. He's IntelliTravel CEO and co-founder. And just listening to talk, we have brought up that American Airlines technical glitch that happened on Christmas Eve. Resolved itself pretty quickly, Paul, but he brings up something that's so true, which is just the general fragility of air travel in this country. And I think about that every time I walk to the gate, approach the counter, and I notice they're still using like a dot matrix printer.
Right.
I don't know why, like the only people in this country, in this world, still using dot matrix printers, but that network of systems still very antiquated. I know there's been a lot of effort to modernize things, but we'll see where that goes.
And it's as simple as, do we have enough people in the towers, the air traffic controllers? And do we have enough, do the airlines have enough people at the gates? Right, the pilots, and we don't have people at the gates. I'll get on a plane when somebody pays me to. That's kind of my strategy these days. So, you know.
David Gura here with Paul Sweeney. Coming up here, Lauren Sadel-Baker, economist at ITR Economics, is going to join us as we look at the U.S. economy, how it's performed in 2024, what it's going to look like in 2025. This is Bloomberg.
All right, good Thursday morning from New York City. Bloomberg, it's a special edition of Bloomberg Markets. Paul Sweeney alongside David Gura. We're simulcasting Bloomberg Markets here on radio and television, so that's kind of cool here, looking at the markets here on this holiday after Christmas. S&P 500 off 11 points. That's about 0.2%. The NASDAQ's off 37 points, also about 0.2%. So not a lot movement at the index level. Volumes are light, as you would expect. Looking at the 10-year Treasury, a little bit higher here, 4.63% on your 10-year. Commodity space, WTI crude oil, we are steady at $70 per barrel. Again, I'm watching Lawman, so I know all about the oil and gas business. So I'm just quoting it. 70 bucks. They're making money. Their cost of production is like 50, so they're making money. I'm feeling good about my friends down in Texas and Louisiana. So all that is good stuff, David.
Something might not be feeling as good about is the federal deficit. The incoming Trump administration facing the worst trajectory for federal borrowing in modern day history, with the deficit projected to exceed 6% of GDP next year. It's something